Good morning, everybody. Welcome to a new day in trading. I hope you're doing well. Morning, Kay.
Good morning, Ryan. Good morning, everybody.
How you doing, mate? You all good?
Yeah, all good, all good, all good. Apart from a bit of frustration, but I'll tell a little more about it later.
Oh dear. Okay, we'll get that from you in a bit.
Right, just before of a short-term trade.
Yeah, tell me about it. Right, just before we start, just want to obviously welcome everyone to the room, and also just to let you know some news that's going on with the ForexAnalytix platform. I'll just pop that there, and I'll pop a link into the chat room as well. Prices are going up shortly for the chat room, and the platform itself. So if you want to get in before the price hike, if you lock in your price now, you get grandfathered in after the price hike, so you won't get boosted up, and you keep those prices for as long as you subscribe. So before those prices go up, you can also grab 20% off the current prices with this exclusive discount for Forex Flow. Just use that code there, FFL20, and you can get that discount. Again, it will keep that price for your subscription as long as you subscribe, even after the price hikes go up. And I should also drop in as well that if you want to have a look at our funding program, if you're thinking about you want to upgrade your trading, you want to trade more amounts, trade someone else's money, you can also do that via the ForexAnalytix funding program. Again, I'll drop a link in there, and that's a look at the page. You can find that on the Forex Flow site as well by clicking on funding program. It'll give you everything you need to know about that. If you click through this link, it'll give you further details, and there's even a video from Blake there. You can trade up to $1 million account if you pass the assessment. That will also give you free access to the ForexAnalytix platform and chat room, so you won't be alone. You can come and speak to other traders who are taking part in the program as well, and any help you need. So if you want to check those out, please do so. But otherwise, let's get on with the show. Right. The central bank floodgates have been opened. I was waiting for this last week. I thought we might get them starting Friday and the weekend, but no, they left it till yesterday. So tons of central bank stuff to get through today. Let's pick out some of the, I wouldn't say less important ones, but some are more significant than others. We'll start with the RBNZ. Governor Orr said the tightening cycle is very mature, but there's still a little bit more to do. So this is pretty much confirming that the RBNZ, as we know, have maybe got a couple of hikes left in them before they, at the very least, pause. So that was Orr reaffirming where they're at, that they're getting to the end of the road of this current hike cycle, and they're going to head to a pause. Whether that means they stop hiking altogether and that's it, they found their terminal level, or whether they're going to sit and see what happens, and maybe if inflation keeps going and so forth, they'll get back hiking again. We don't know, but that's their pause level, if you like. Expected to hike 50 pips, I think, at the next meeting. Is it? Do you reckon it's 50 pips at the next two, or 50 and make a call at this one, Kay?
Orr said that they may start to slow in the last meeting as well, but I think for next week we're still expecting 50. Let me have a quick look at that. It's an interesting question. When is RBNZ? On the 5th. On the 5th.
Yes, it's a week, isn't it? Yeah.
Yeah, that's a week from now. Oh, there's no expectation right there, but I think I saw somewhere 50 or so. Yeah. The interesting thing about this, because everybody picked up on what they said about the hiking cycle being very mature, but then if you read it, the whole comment that he gave, There is still some positives in there, and the market did not really pick up on it as it happened. But he did say, let me just find it back. There's a, yeah, here it is. While the tin may be higher, the cost of getting the tin there is much lower. As well as energy prices, you've got a lot of offsetting positive supply shocks starting to help us. In a relative sense, New Zealand sits in a very strong position. We've come through this extremely well. And I think that's one of the reasons which I hadn't picked up either yesterday evening, because it was getting very late. That helped, together with a little bit of a setback in the dollar, that helped the Kiwi to recover. So it's not all not all saying that they are going to stop, but they also say that the situation is not too bad. So he's not talking about recessions and stuff like that. So I'm reading in the same article, it says that so they raised to 3% so far, and by early 2023 they're expected to end up somewhere around 4%. So is that we've got
that'd be
before the year end, maybe a 50 and a 25, and then another 25. Yeah, I'd say 50. Bank on 50. I mean, since the rest is raising quite rapidly, fast, front loading. I think 50 is reasonably to be expected, I reckon.
Yeah, they'll probably be about right. 2 more 50s and done at pause at 4% seems about right. Yeah. Okay, cool. Thanks for that, mate. Right, moving on to some of the others. So we had ECB's Lagarde at a economic hearing in Parliament. Had quite a funny comment that she's absolutely determined to get rates to neutral, but she doesn't have an idea where neutral is. So how long's a piece of string? We had a bit of fun with that one yesterday, didn't we, Kay? Pretty much summing up the ECB.
I mean, it's something that we hardly can expect from the governor of the second largest central bank in the world. I was really rolling over from laughing on that one. She hasn't got a clue. She's nearly as good as Bailey.
Well, I'm going to talk about Bailey in a moment, because we'll have a row about this, I'm sure. Well, disagreement. He's got up in my estimations, but we'll come to that in a moment. So that was ECB's Lagarde. Now, just quickly over to China. The MOFCOM, the Ministry of Commerce, said that exporters had reporting falling orders. So some signs again there of potential weakness in the Chinese economy. But apparently the state have asked their banks to go out and buy stocks ahead of the planned party congress, which is coming up in October. So, you know, you talk about manipulation, you don't get much blunter manipulation than that. What they want to do, they've got the big party congress where they going to announce how great everything is. And what better way to get the population on board by boosting their stock levels, their equity levels. So that's what's being sent out from those guys.
And they're even giving them the money to do so, because POC has put in the largest amount of liquidity in the market in a good number of years this week and last. So all of that is, if you want to pump it up, still I don't think it bodes well for the Chinese yuan right here and now, unless the dollar starts to turn around, of course, in itself. Yeah,
and exactly. And obviously, what's happening in $1 is a natural boost for exports as well. You know, the currency weakening that gives exports a boost, makes things a bit cheaper for people buying from abroad. But yeah, you know, that's all going to play into the one. But there's going to be a lot of talk around this party congress thing, a lot of back patting, a lot of strong words, how good things are going to get, that sort of thing. But it could also be boosted by talk on what they're going to do to get growth back on track. And if that's big easing, you know, the reserve requirement ratio cut, which is the pretty big one in China, then obviously we're going to see potentially further weakness in the yuan. So that's that from China. Anyway, we've got some shenanigans going on in gas pipes as well. Nord Stream 2 had some leaks. Nord Stream 1 had some unplanned unavailability and some pressure drops, and I think some leaks there as well. There was some headlines out this morning from Nord Stream saying that the damages are unprecedented. Now the Nord Stream 2 thing, this was reported yesterday, I think. So forgive me if I'm getting myself confused. It's a bit of a mess trying to decipher what pipeline everyone's talking about. The Nord Stream 2 pipeline, I don't believe is fully active, but it still contains gas. This was the one that was all going to be, you know, connected up to Russia, and the new pipeline opened up. So even though I don't think it's fully active, it does have gas in it, and there was leaks there. Now there's been some other stuff going on with Nord Stream 1, and these leaks, as Nord Stream said, the damages are unprecedented. So we don't know if there's something going on there, sabotage, anything like that. The conspiracy theories will be pumping that one. Long and short is it's problems with gas supplies yet again, and that's the main point we can take from all this. Have you heard anything more about, or have you got any bit more insight into these pipeline stuffs or greater understanding, Kay?
Well, I mean, the one thing I read is that the gas is just flowing into the Baltic Sea. Yeah, I mean, we don't have to be too big conspiracy theorists to know what's going on there. It's a way of putting pressure on Europe, and I think it's been going on and it's ongoing, and it will probably not be solved until somebody is put really with their back against the walls and see what happens there. I mean,
yeah,
I don't think there's too much to say about it, apart from the fact that Russia is playing the game against Europe, and that's it.
Yeah, and as we slowly creep towards winter, of course.
Exactly.
Yeah.
And
Now
just one thing
yeah.
to come back on this on the China CCP Congress. That's starting only 16th of October, so it's they're going in early. Another 2-3 weeks 2 long weeks to put pressure on stocks, likely on the upside, and yeah, they are preparing it early.
Yeah, so we could in fact start seeing some moves as early as next week, maybe, if not already. So yeah, keep an eye on that one if you trade anything to do with China. Going back to let's go to the EU and keeping it on oil and energy. As usual, they're top of their game in this one, and they now may delay Russia oil price caps because there's divisions among them. Big shock there that they can't agree on anything this lot. So divisions there on the oil price cap. And while we're speaking of Russia and Putin, he's set to speak before both houses on Friday. The topic is likely to be these referendums that have been held in Russian-held points in Ukraine, you know, or affirming them as Russian territory. And we know from that the threat level has been raised from Russia on territories that are Russian and protecting those territories. So announcing that those referendums in Ukraine, potentially making those parts of Ukraine Russian territory, ups the ante a bit on what happens with the conflict. We've had Medvedev out again today, throwing around that nuclear weapons are there to be used when necessary. So that's coming out on Friday. We need to obviously watch what comments we hear from that and how the rhetoric or comments step up from that point, and what he says about those territories. It could obviously add to the risk pressure that we see in markets after that. Right, let's crack on with some of the other central bankers. I might leave Bailey till last, actually. We've had a lot of Fed heads out, quite a lot of waffle. Collins, one of the new bods at the Fed, said a softish landing is challenging. Evans was out this morning saying he sees rates consensus at 4.25 to 4.5% by year end. Rates are currently 3.25%, so that's, or the midpoint is 3.25%. So that gives roughly about a 0.25 of rate hikes he sees coming more from now. He also said he would welcome unemployment at 4.5%. So again, wanting to hit the jobs market, the unemployment rate is currently 3.7%. So quite a bit of pain there to get the rate up to 4.5%. Again, I'll reiterate, when looking at jobs, there could be a situation where we don't actually see significant job losses in the NFP, but more so the participation rate rises, which would, I wouldn't say artificially raise the unemployment rate, but it would get the unemployment rate up. So they could have a situation where there's still tons of jobs coming in, but the unemployment rate gets to 4.5% purely on the participation rate rising. What the Fed does with that type of scenario remains to be seen, but it wouldn't be in terms of the economy losing jobs per se. I don't know what they'll do with that, but we shall see if that's what happens. Mester came out with some comments, but first I'll go to Bostic, because this one really hit me yesterday. He came out and said that the action of global central banks is not so uncoordinated as some think. Now, we've been talking, obviously, for a couple of weeks now about the possibility of increased comments over dollar strength coming from central banks. We've obviously seen what's happened in the yen. We've seen what's happened in the pound and the pressure that came on the Bank of England yesterday. Now, this is Bostic saying that, talking about coordination. He also said that there's potential risk to the US from recession contagion, or what happens in other countries, and he cited the events happening in the UK as possible risks for the US. Now, I'm not suggesting that we're going to see intervention tomorrow, or we're going to see big statements coming out tomorrow, but we know that central banks talk to each other a lot. That happens all the time, okay? All we don't get is the results of those conversations. We don't hear about what they've been talking about. But this is a central banker now coming out and saying, hang on, folks, don't think we're not coordinating behind the scenes. He's making this comment public. And I think, add that to everything else that's going on, we are creeping up that risk ladder of where potentially we might get stronger comments coming from more central banks about what's going on in their economies and their currencies, and particularly the dollar. So that was a key comment for me yesterday. Now, just to throw some context at that, Mester came out and said that the Fed sets policy that's appropriate for the US. Again, perhaps a key comment, you know, why is she mentioning the US? Of course they set policy for the US, but why make that comment specifically? I think it's because this is part of the conversation of what US policy is happening in the dollar and what that's causing global markets and other economies. Because she also said they don't set the value of the US dollar. So again, they're commenting on the currency, they're commenting on what their actions are doing. This is now two Fed speakers around about the same subject. So I'm expecting this sort of chatter to start increasing. And obviously, look at it like the Bank of Japan Ministry of Finance. We're at pretty low levels of rhetoric. Will they creep higher? That's going to play into the dollar. I think we're on the way there. We could be quite some way before we actually get to real strong comments. So for that, they say two key comments there, and it's got me itching a bit now about maybe getting into some dollar shorts for a long-term trade. I think we could be getting to a point where we're near the top. The Fed are on their path. We've seen the price adjustment of the dot plot rising. The market is now pricing in those potential higher rate levels. It's going to take something more hawkish to get those even higher. So we might be at a level where, for the moment, we might see a pause in the dollar. We might see a pause in rates. We might have some room to go on yields a bit more, some higher in the dollar. But I think we creeping towards a point where we're going to see at least a pause in the dollar, maybe a turn. So from that, let's go on to the Bank of England. Now, my thoughts yesterday was that the BOE shouldn't do anything, shouldn't act. At the very most, come out with some comments, but otherwise, I think they should have just left the market alone to throw its hissy fit. Let the UK press scream and kick and throw their toys out the pram about the end of the world for the UK. And the market waited and waited, and we got these comments that the Bank of England were going to issue a statement that saw the pound lifted up towards 107s, 108s, even creeping up to the 109s. And then Bailey came out, pretty much gave a very weak warning. They're monitoring developments in financial markets very closely, will not hesitate to change rates as necessary to return CPI to the 2% target, and they're going to leave it all until the November meeting. So no hints of anything coming up, intervention, emergency rate hikes, all that sort of thing. Personally, I think that's exactly what they should have done. They can't pander to the markets. Too many central banks pander to the markets. And what's happened today? At the most, the volatility has been sucked out from what we've seen the last couple of days. Okay, we're still very jumpy in the quid, but it's settled down a little bit. We're not seeing 200-300 pip swings at the moment. So on that basis, job done. Does it mean we've seen the end of the pound falling? Not necessarily. We're going to be in a position now where we need to see how the market still reacts to the Chancellor and all these tax cuts and everything else going on. So I'm not saying the pound is out of the woods. I'm just saying that the volatility has been sucked out of it. I think Bailey's done the right thing. Rather than doing any emergency measures, that would have just sent more panic in the market, in my opinion. Kay, what do you make of Bailey?
Well,
Not the greatest fan, I know.
Yeah, I mean, everybody knows my opinion about Bailey by now, but perhaps you're right. Perhaps it's right not to say anything and let the market drive itself into the wall in that respect. But I was, to me, it's still a case of they're not in control. So we never know what's going on in their own mind. But
Yeah.
by not saying anything, it may also mean that they don't have a clue about what to say. So I'm still not convinced that they are doing the right thing. Now, that's not to say that I know exactly what it is to do the right thing. I'm only a trader. I let the guys explode themselves, and then I try to pick up a bit of monetary pieces what I can get out of it. So as one says, to us is not the reason why. To us is to sell and buy, right?
Yeah.
But yeah, I don't think. Well, for first, I don't think that they fully expected this kind of move. Whether it be on yields, whether it be on the pound. So they left scratching their head. That's my opinion, and he's not also doing anything to alleviate concerns in the market. Today we're seeing the yields come off a bit, but it's a global thing. US 10s have hit above 390 yesterday. I think twos are close to or somewhere around, what was it,
427. Are you talking US or UK?
Yeah, the US, it was 435 or so on the twos, 436 even, and now they are coming back to sub 430. The UK 10s are coming off a little bit as well, but I'm afraid it's just a temporary thing. So I'm not sure that I'm in agreement to say that ultimately the right thing. Yeah, and to continue on that subject, Kwarteng came out saying that what is it, 3rd of November or so, he's going to
23rd, yeah, 23rd.
announce more. But 5 weeks is a lifetime in financial markets. So I'm still very cautious on the one side and worried about the pound really. I don't think the market is going to get confidence out of what Bailey and his colleagues said yesterday.
Yeah, and yeah, it's a 23rd of November, which is, I think, it's the actual budget day, autumn statement, where set to announce potentially more tax cuts and have a full review on how they're all going to pay for it and how it's going to be paid for. And the OBR, which is the Office of Budget Responsibility, who have never got anything right in their entire existence, are going to be costing it out and doing an independent report, as it's called, on the finances there.
Yeah.
So it's coming 23rd. Yes, mate.
Yeah. Didn't IEE, what is it? NISR also, didn't they come up with some things saying that they are going to need to up the borrowing costs to above 100 billion pounds a year or so to pay for these?
Yeah,
stuff?
I think there's been a few of those out.
Yeah.
I think I put one in the chat.
I think that's where the market is so worried about and cautious about in or selling pounds really.
Yeah, and I think the market is justified in its thoughts. I think the market is justified in its thoughts, but what needs to be remembered is that the UK isn't going to be the only one doing this. It's one of the first to come out with all this in greater detail. You know, it's going to take the EU 7 years to get their recovery fund up and running for 1.85 trillion, and people, you know, everyone's hammering the quid over an extra 100 billion borrowing. You know, the chicks are going to come home to roost in a lot of economies, and it likely in the end.
I agree that I agree on that, and I also was a little perplexed, but that was because of the speed of the cable decline, of the sterling decline, that euro sterling managed to make it up into the 92s on that move.
Yeah,
I think that was in the context of everything that's going on over Don. But as you say, I mean, it's everywhere. We'll come to that on the yen, because I had an interesting question in the room this morning about the 20-year yen yields rising above 1%. I'll give my thoughts on that in a bit. And it's everywhere, as you say. It's in Europe is the case. It's in sterling is the case. The problem is the difference in volume, right? The sterling is undeniably a smaller pot than and there's less liquidity than in the euro block. So the moves can go faster in the sterling, and it's really a confidence crisis, right? Are they going to be able to sponsor it? What is the Bank of England going to do with it? And then you add all those little things on the side. Brexit is not completely done, and the dollar is the cleanest shirt, and all of that is just adding on to the pressure. And I want to just pick up on Mike saying that do you believe sterling's reserve currency status is threatened? I think it has already been going down over the years, because well, I mean, of course, people, if you lose confidence in a currency, in how a government can handle their finances, you're going to lose percentages of reserve status. But also don't forget that China has made a big push, and from the Asian side, there are countries, and now we see Russia as well, who have increased their Chinese holdings. SDR as well has adopted the CNY. So yes, definitely. But the reserve currency status in the case of the sterling, it's already a lot lower than euro, dollar, for instance. But yes, it has lost already a bit. Will this increase this uncertainty, increase the threat, or diminish the reserve currency status? It can, but if down the line, and I still haven't given up completely on that idea, if down the line, and that's going to depend on how the UK rebuilds the city of London and their biggest cities. But if down the line, with those tax cuts, they manage to get firms back into the UK, and especially a part of what the Europeans took out of it. And with the levels of the sterling, it could get attractive to do so with tax rebates. Down the line, it may actually end up, but we'll have to see when that happens. It could be 2023 or 2024, or even later. But I think probably somewhere 2023. It may see a revival of the sterling actually, but not right now. That is my base case.
There's always two sides to the coin. You can look at the woes of the UK and the drop in the pound and how that's all doom and gloom. But if you're not from the UK, you've got some potential buying interest because of the level of pound. I mean, let's just take one case in point. Let's look at Amazon. Okay, they were looking to. There's been rumours for a while about taking over an online shopping brand, delivery brand here called Ocado, which I'm sure you've all heard of. Now, if they were looking to do that when the share price was £9, and cable was 120, how much cheaper do you think, or how much better a prospect it looks now the share price is £5 and the pound's 108? You know, you can't rule out the other side of the coin, is that a low currency in a good country like the UK, you know, rated well, will attract investment, will attract inflows because it becomes financially better and cheaper to do so. It's good value. So there's always a flip side to these things. How they all play out over time remains to be seen. I put a story up in the newsroom today about the potential for, you know, mergers and acquisitions happening, you know, much faster, much more, because people can come into the UK, buy up firms, bankers or bonuses, caps have been thrown out. That's a boost for anyone selling a company in the UK now. They can get a good bonus on the back of it. You know, there's always two sides to the story in this, and we shouldn't always be focused on the negative side as well. But yeah, let's not dwell on it too much. I think Bailey did the right thing. I never rule out the fact that they can still do something stupid. I should make that clear. They could turn up today and do an emergency rate hike. You know, you wouldn't put it past them. But initially, I think what he's done was sensible, and we'll see where the pound goes from here. Kay, do you want to have a look around? Oh, let's quickly, Mike, on credit rating agencies. Yeah, that's always something to watch, how they view things. Obviously, a big downgrade to ratings affects investment as well. We won't know that until we start to see the real numbers. So maybe after we get the real numbers in November, we'll start to get some comments on that. But that's on the credit agencies. Okay, Kate, do you want to have a little look at the prices that I've been waffling on for so long?
Yeah. I'm going to first take Nick's in our chat room question about the Japanese yields. There's been a bit to do about the 20-year yield, which we see here moving over 1%. Okay, there's a few reasons for that. But first of all, there's since Japan is part of the G7 and money managers have investment rules and investment models. If the rest of the G7 yields are flying, whether it is the short, the longer end, Japan is in part going to participate with it. Now we know that the Bank of Japan is controlling the 10-year yield. They are still buying 20 to 25-year bonds as well, but in much lesser, to a much lesser degree. And so, first of all, there's this correlation, because we have seen, if you look at the 20, the 30s, okay, they've rallied higher today. They are a little bit lower, but they've rallied over the past month. if you look at the 20s, they've rallied as much as you like as well, and they are trading above or now at around 4%. So there is this, first of all, this correlation part. Then, as we have seen, and which could also be explained by correlation, and we talked about it, about how much the UK has to spend and borrow for their spending program. How much is the EU going to have to spend for their borrowing? And we can't forget that Japan is also putting in stimulus package after stimulus package, so that has to be funded as well. Of course, the government is going to fund on anything which is up to the 10 years as well, but there's going to be parts where, since those rates are around 1% and we're just coming out of the pandemic and they have been low, but still not that high. If you look at the 2021 lows around 0.6, if you look at the 30 year now at 140, or if you look at the 20 year just being above 1%, they're going to be tempted to lengthen maturities as well, to lock in still historically low yields. So that's a part of it. And then on the other side as well, is that the longer you go in those maturities, the less there is this huge pot of liquidity. Of course, Bank of Japan is controlling everything up to the 10 years. But if you go out longer, they're controlling it less. So there's less liquidity as well. There are less players in the long to ultra long maturities. So that explains in parts the volatility and the hikes in those yields as well. And then let's face it, you will have speculators who seeing that since there is less liquidity in there, it's a bit easier to drive those bonds lower, the yields higher, because the rest of the bonds in the bond markets globally are getting destroyed. So it's a combination. I don't think it has a big impact as we talk about it, a big impact on the Japanese yen for now. I don't want to read too much into the Japanese yield curve unless it may be putting some more pressure, some additional pressure on the Bank of Japan by the markets. But to be fair, I think it's a pretty natural and correlative move that we have right now. So I'm not going to say that these moves, unless we start to see higher yields for longer, you start to go, okay, this is a bit of a level. But if you look at where we were, crises and stuff, yeah, we've gone through a level if you look at it technically, but I'm not sure whether I want to read too much into this unless we're starting to go to creep up to 120s and above. So that a bit for those Japanese yields. All right, let's have a look at a couple of currencies because it's heating up, right? It's very hot on the sterling. So we had this flush out the other day. Since then, we are hovering around inside this double line here, which is about. Let me put it on a little bit closer here, and we have to take into account the liquidity, right? We are hovering around this 106.2530, which was a level to 50.70, and then the top side yesterday we failed to crawl back above this trend line, which is in around the 109.40.50 zone, which I think if cable manages to get back above there, we can rally a bit further, perhaps back to the 112. But with everything that we are going to look at now in the dollar pairs, at least, we have to take into account end of month, end of quarter, and then also the end of semi-fiscal year in Japan. So be careful for moves that would be perhaps not fundamentally correct, but but watch out for funny moves. And when I look around the equity market and the bond markets, I wouldn't be surprised if we see some more dollar demand. But I'm taking a bit of a bet here. But I wouldn't be surprised if the models show that the market needs more dollars into this end of quarter. But let's wait a little bit to see what they say. For me, that's where we trade in between this 106.30.70 and the 109.40.50 on the cable. Euro dollar, we went down to the bottom of this channel around I've got it around 95.70. We overshot just a little bit. I think that's going to be a bit of an important level right now. 95.5. If ever we get below there, why not 94.5? We need to start to retake, I think, and keep the 96.60, which is already difficult enough right now, before we can talk about a deeper recovery. Most of it will depend on how the dollar reacts and how those yields react into the end of the month, and perhaps we need to wait for the start of next month to see what the money market people want to do with it. For the time being, actually, I've read an interesting article saying that people prefer to be just in reserves and in money market instruments, because now they're getting real returns. If you look at the 2-year yield is above 4%. If you look at the 1 year is above 4%. So why? So and I've read the money managers, and I'm quite in agreement with them. Why would they put their risk into stocks or into other assets when they can get 4% on or anywhere between, if you look at the Fed funds, anywhere between 3 and 4% on any of their instruments? Why would they buy more risky assets where they can expect less betting on a revival of the equity markets, where they get at best I think something about somewhere between 1.5 to 1.75% on return on coupons, etc. So here we go. So that's for the euro dollar. Covered that one. Dollar yen. I think dollar yen is not showing too much, and I think it's telling that we are back above 144 after those interventions. And I'd also be a bit careful into the end of this semi-fiscal year. I was looking at this. I traded it actually. This 143.70s. Then you got 143, which is relatively interesting as well, being the 50% of the last 140.5 move. And then we are having those. Sure, I thought did I put it on the shorter term perhaps? Yeah, we're also, people will be watching the retracement on interventions, and those are actually also coming in around 143.70, around the same levels, because the intervention took us down nearly to these prior levels here. In my opinion, if for as long as Bank of Japan doesn't change anything, for as long as the Fed speakers don't change too much, I'm going to remain in a buy the dippers camp still. Moving on to Aussie. We've been, I should put these a bit further. We've been to some possible extremes here on those washouts. I like this 61.8 really around 64. Where is it? 65? Try to trade off it with a very tight stop around the prior lows. I want to see what's happening there. I'm not planning on keeping that one for too long, but I'd like to see, and we've nearly gone there. That was the first retest, 65.17. I think there is a possibility if we get a full-on turnaround Tuesday, at least for one day, to perhaps go and have a revisit up there. But if we get back down below those prior lows, it's bad news, and it will mean that people still need a lot more dollars. A little bit similar, we've got those long-term trend lines in the Kiwi here, which we have been toying around on the big drop, but we are holding somewhere in between. So I'm going to respect those ones. So it's 56 on the downside, 56 around, but depending on the pencil, 3/4, anywhere between 56 3/4 and 90. We're turning around there right now. Same thing, possible that if we get a bit of a turnaround Tuesday, that we have a bit of a relief here as well going on. But then I'll be very cautious into the end of the month. We can talk quickly. So the dollar max ran into this 20.42.45 zone, which I talked about as well the other day, seeing a bit of resistance, but for the time being, I'm staying out of it. I think we need to get back below 2020 or so to call this over. So until the end of the month is over, I'm going to stay aside on that one. On the Euro mix, frustrating, because I thought with the risk off that we would have at least a chance to get back up to higher levels, but it's really not giving us a lot of joy. We're turning around this 2060, 60, 62 zone. I'm going to keep an eye on it into the end of month, tiny in it, but if I don't get any higher retracements here, I think we might be on our way to perhaps 18s or low 19s. Quick look on the oils. Gold, first of all, went down close to this 1614 zone. We're trading back into the 1640s, but I think still 30s, sorry. But I still think for as long as we trade below 1648.52, somewhere there, it's not looking great. Silver, ditto, but I still think, of course, the percentage moves are bigger than in gold. But I still think that if we survive the end of the month above, especially, well, I'm not even going to say above those prior lows, even like this, that is even a buck lower than where we are now. But if we start to survive here, perhaps come October, if yields don't pull up further, perhaps there may be something to do here. Yeah, oils. We ran into the 78.6, and that seems to be holding right now. We're trading around 77.80, but we need to get back above 78 to really start going there. In my opinion, even retaking 79 would be needed to really start going. But it might just be enough right now. And Brent, same picture. We need to get back above 86.5, 87 to really go a lot higher. Everybody is interested about the S&P 500, but I'm really not interested in trading much of it right now. It's going to be the same thing. If we get a turnaround Tuesday move, we can perhaps make it back to. This coming in around 37.40. Yeah, 50 points higher than here. Why not back to 38 somewhere around there? But I'm not sure whether all those moves going into the month end will be ultra viable. Keep an eye on this one. If we start to get backs up 20, 30, 36, 20, 35. The party may, well, not even the party, it may look sour again. That's it for me, Ryan.
Yep, no worries, mate. Thank you very much. I'll grab those back quickly. I'll just do, we won't keep you guys and girls too long, but I'll just do a quick run through a couple of things that I'm looking at right now. Gold being one of them. I'm still short on this one. I'm looking for a break of this 50 fib. At the moment, we're pulling up pretty much ahead of it in the 20s. I want to see a break of this fib, and then potentially we're heading down 1600, maybe a bit more. Looking at the short-term picture on that one, you can see I want it to hold this below this 1640-41 area. I mentioned this yesterday in the chat room, I think, or on the F.A.C.E webinar. The breakdown of this area in the 60s is obviously where I got short 65s. Now we're getting that confirmation that this area has become resistance. So I'm looking for further downside. So for me, if you're looking at gold, you're looking between this fib and this 1641 area as the decider of what happens if we crack back above there. Likelihood is we're going to get a test up towards the big break point in the 1670s, 80s up there. That's for gold anyway. Euro sterling is another one I'm still sitting a little bit short in, been chopping and chopping on the way down. Managed to get a nice entry, 99.90. Little bit of a Putin trade ahead of those comments that he was set to come out with. And again, you know, looking at the longer term levels, this 96 area is a bit historical. Let's see if I can get it back there. So it goes right back to this area here and even further, you know, back in the early 2000s. So just looking at this, you know, this former resistance point, support point, which comes in around about this 96 area. So again, it's another one potentially that's going to be key for what happens with the euro dollar. We've had this spike over following cable and everything that went on the other day. It has had a few tests under. It's doing a bit of a similar thing to what it did up at parity and 99, where it tested it. You know, would it get under? Let's have a little look, a bit wider quickly. Need to go a bit wider than that. Where am I? Oh, let's go into this chart. It's probably all in here. There we go. So it was a similar play to what happened at 99. Now we had a dip under, then it was support, then we had a break, decent break. You know, it's setting up for that type of thing going on here at 96. So this could be a fairly significant level here, maybe similar to 99, depending on how the price action plays. If we need to reverse that, we've really got to get above 97, probably 97, 15, 20, clear that, and then potentially we've got further upside. So that's the range I'm looking for in that one anyway. The only other trade I've got is I'm still playing a short off the US dollar Hong Kong, still banging its head up there. For those that may not know, there is a trading band in play between 7.75 and 7.85. So I'm just sitting in short, and anytime we get a move down towards 84.50, I'll let them off and reload it back up here. So that's what I'm playing on that side. Got some other trades on the cards as well, but the guys and girls in the chat room will know what those are. Right, so, oh, Evans is out. Let's see if he's got anything interesting there. He expects inflation to cool substantially over the next couple of years. Okay, thanks for that. Right, with that, folks, keep an eye on the data today. We have got, let's start the calendar quickly again. We've got durable goods today. That needs to be watched at for the consumer aspect. Obviously, durable goods are things like white goods, washing machines, tellies, that sort of thing. So it is a little bit of an insight into the consumer. Are firms ordering these goods because they're confident of being able to sell them? So that's what we look at durable goods for. But we've also got some housing data as well. New home sales at 3 o'clock this afternoon UK time. Before that, we've got house price indexes, the FHFA and the what do you call it? Case-Shiller, that's the one. So that gives an indication on housing. New home sales also have some price components as well. Prices are the last thing I'm looking for, the last domino to fall in the housing market, before we can say that it's potentially crashing, or at least really tipping the boat over. We've seen dips in the numbers, things like building permits and starts, sales, existing sales, new home sales, but prices have still held up. I think last week we saw prices taking a dip in the existing home sales. I think it was last week. We need to see if that's going to continue. If prices start rolling over significantly, we are facing big problems for the US housing market. That's an effect of rate hikes. That's something the Fed's going to take notice of. It plays into their soft or crash landing, whichever way you want to look at it. Anyway, that's that for today. Please enjoy your days. Trade well, trade safe, make loads of pips. Thank you very much to Kate. Thank you very much for coming to the Flow Show. We shall see you tomorrow. Have a good one.
Have a great day, guys.